Explanation: net present value (NPV) is the dollar amount today of all cash flows a project will generate after moving each future cash flow back to today using a discount rate. Formula: NPV equals sum from t equals 0 to n of Cf sub t divided by 1 plus r raised to the t. Where Cf0 is the initial investment, usually a negative number, Cf sub t are the cash inflows or outflows in year t, r is the discount rate, and n is the final year. Decision rule: if NPV greater than 0, accept the project, it adds value. If NPV equals 0, indifferent, the project earns exactly the required return. If NPV less than 0, reject the project, it destroys value. Think of NPV like comparing the price of a fruit basket you buy today with the value of the fruit you will eat over the next few weeks. If the future fruit's worth after accounting for the fact that a fruit today is more valuable than a fruit tomorrow exceeds the price you paid, the purchase was a good deal. Incremental cash flows are the extra cash that will occur because the project is undertaken. They are broken into 3 parts. 1. Initial outlay Cf0. Money spent at time 0, purchase of equipment, installation costs, and any net working capital increase. Example, buying a new machine for $500,000 and needing $50,000 extra inventory, so Cf0 equals negative $550,000. 2. Operating cash flows OCFT, cash generated each year from the project's operations. OCFT equals open parenthesis revenue sub t minus cost sub t close parenthesis times open parenthesis 1 minus tax rate close parenthesis plus depreciation sub t times tax rate. Depreciation is added back because it is a non-cash expense, but it creates a tax shield. 3. Terminal value TV. Cash flow received at the end of the project, often the salvage value of equipment plus the recovery of working capital. Example, after 5 years the machine can be sold for $100,000 and the $50,000 working capital is released, so TV equals $150,000 in year 5. Only cash flows that change because of the project are counted. If a cost would be incurred anyway, it is not incremental. The discount rate reflects the opportunity cost of capital and the risk of the project. The most common choice is the weighted average cost of capital, WACC. WACC equals E divided by V times R sub E plus D divided by V times R sub D times open parenthesis 1 minus tax rate close parenthesis. Where E and D are market values of equity and debt, V equals E plus D, R sub E is the cost of equity, often derived from CAPM. R sub E equals R sub F plus beta times open parenthesis R sub M minus R sub F close parenthesis, and R sub D is the after-tax cost of debt. If a project is riskier than the firm's overall risk, an additional premium can be added, for example, a 2% project-specific risk surcharge. Conversely, a low-risk subsidiary may use a lower discount rate. Analogy: think of WACC as the interest rate a bank would charge you to borrow money for a similar risk. You discount future cash flows at that rate because you could otherwise earn that return elsewhere. Present value PV factors turn future dollars into today's dollars. PVF sub t equals 1 over open parenthesis 1 plus r close parenthesis to the t. PVAF sub n equals open bracket 1 minus open parenthesis 1 plus r close parenthesis to the negative n close bracket divided by r. These numbers are pre-calculated in annuity tables that many textbooks provide. Example: at 10% discount, the PV factor for year 3 is 0.7513. The 5-year PV annuity factor is 3.7908. Using the table saves time. Multiply the cash flow amount by the corresponding factor, instead of doing the exponent math each time. Equals PV open parenthesis R comma N comma negative PMT comma 0 close parenthesis. Practical tip: always check whether the table you use assumes payments at the beginning annuity due or the end ordinary annuity of each period. The factors differ slightly. Explanation: non-conventional cash flows are streams where the sign changes more than once. For example, a large upfront outlay, then positive cash flows, then a big cleanup cost at the end. Such patterns can produce multiple IRRs, different discount rates that make NPV equal to zero. Because IRR can be ambiguous, NPV remains the reliable decision tool. To handle these cases, plot NPV versus discount rate to see where the curve crosses zero. Each crossing is an IRR. Use the firm's required return WACC as the benchmark. If NPV at that rate is positive, accept. If negative, reject. If you still want to report IRR, disclose that multiple IRRs exist and explain why NPV is preferred. Analogy: imagine a roller coaster that goes up, down, then up again. The height where the coaster crosses a certain line can happen more than once, just as IRR can cross zero multiple times. NPV, however, tells you the overall net height at a single realistic discount rate. Sensitivity analysis tests how NPV reacts to changes in a single input while holding others constant. Typical steps identify key drivers, for example sales, growth, cost of raw material, discount rate. Choose low base and high values, often negative 20%, 0%, positive 20%. Recalculate NPV for each scenario and record the range. The result shows which variables the project is most vulnerable to the sensitive ones. Scenario testing goes a step further by changing several variables together to mimic realistic situations. Best case: high sales, low costs, low discount rate. Worst case: low sales, high costs, high discount rate. Most likely base assumptions. These help managers understand upside potential and downside risk. Visualization tip: a tornado chart ranks sensitivities from most to least impactful, making it easy to see where to focus risk mitigation efforts. Projects rarely have identical lives, yet companies must allocate capital among them. Two common tools help compare unequal length projects. Replacement analysis: series of identical projects. Assume the short life project can be repeated. Compute the net present value of one cycle, then calculate the equivalent annual cash flow, EAC, by dividing the net present value by the present value annuity factor for the project's life. EAC equals net present value divided by present value annuity factor sub n. Equivalent annual annuity, EAA, convert each project's net present value into an annuity that has the same present value over its life. The project with the higher EAA is preferred. Example: project A lasts 4 years, net present value equals $120,000. Project B lasts 6 years, net present value equals $150,000. Using a 10% discount rate, present value annuity factor 4 equals 3.1699, and present value annuity factor 6 equals 4.3553. EAA sub A equals $120,000 divided by 3.1699 equals $37,860 per year. EAA sub B equals $150,000 divided by 4.3553 equals $34,452 per year. Although B has a larger total net present value, A provides a higher annual return, so it would be chosen if the firm cares about yearly income. The intuition is similar to choosing between renting a car for 4 months versus buying a car that you'll keep for 6 months. You compare the cost per month, not just the total cost. Taxes, depreciation, and working capital changes dramatically affect cash flows. Depreciation, a non-cash expense that reduces taxable income, creating a tax shield. The cash flow effect each year is tax shield equals depreciation times tax rate. Depreciation can be calculated using straight line, equal expense each year, or accelerated methods, larger early deductions. Taxes on operating income. After computing earnings before tax equals revenue minus operating costs minus depreciation, subtract tax. Tax equals earnings before tax times tax rate. Operating cash flow then becomes operating cash flow equals revenue minus costs times 1 minus tax rate plus depreciation times tax rate. Working capital changes. Net working capital equals accounts receivable plus inventory minus accounts payable. An increase ties up cash, a decrease frees cash. At project termination, the initial net working capital is recovered. Practical example: a project generates $200,000 revenue, $80,000 operating cost, $30,000 depreciation, tax rate 30%. Earnings before tax equals 200,000 minus 80,000 minus 30,000 equals 90,000. Tax equals 27,000. Net income equals 63,000. Add back depreciation. Non-cash operating cash flow equals 63,000 plus 30,000 equals $93,000. Alternatively, using the shortcut, 200,000 minus 80,000 times 0.7 plus 30,000 times 0.3 equals 120,000 times 0.7 plus 9,000 equals 84,000 plus 9,000 equals $93,000, confirming the result. A company is considering buying a new packaging machine. Purchase price $500,000 paid today. Installation and training $20,000 today. Machine life 5 years, no salvage value. Expected additional sales each year $150,000. Variable cost of goods sold $70,000 per year. Fixed operating cost $10,000 per year. Straight line depreciation $104,000 per year. Corporate tax rate 30%. Required return 12%. Net working capital increase at start $30,000 recovered at end. Solution steps. Step 1, initial outlay cash flow 0 equals purchase plus installation plus net working capital equals negative $500,000 minus $20,000 minus $30,000, which is negative $550,000. Step 2, operating cash flow each year revenue $150,000, variable cost $70,000, fixed cost $10,000. Earnings before interest and taxes before depreciation equals $150,000 minus $70,000 minus $10,000, which is $70,000. Subtract depreciation $104,000 gives earnings before tax negative $34,000, a loss. Tax shield on loss equals negative $34,000 times 30%, which is negative $10,200, a tax credit. Net income equals negative $34,000 plus $10,200, which is negative $23,800. Add back depreciation, a non-cash item, gives negative $23,800 plus $104,000, which equals $80,200 operating cash flow each year. Step 3, terminal cash flow in year 5, recover net working capital $30,000. No salvage value. Total cash flow in year 5 equals operating cash flow $80,200 plus net working capital $30,000, which is $110,200. Step 4, discount each cash flow to present value using 12% present value factor for years 1 through 4 equals 1 divided by 1.12 raised to the power of t. Year 1 factor 0.8929. Present value equals $80,200 times 0.8929, which is $71,607. Year 2 factor 0.7972. Present value equals $80,200 times 0.7972, which is $63,945. Year 3 factor 0.7118. Present value equals $80,200 times 0.7118, which is $57,102. Year 4 factor 0.6355. Present value equals $80,200 times 0.6355, which is $50,971. Year 5 factor 0.5674. Present value equals $110,200 times 0.5674, which is $62,545. Step 5, sum of present values of inflows equals $71,607 plus $63,945 plus $57,102 plus $50,971 plus $62,545, which totals $306,170. Step 6, net present value equals present value of inflows minus initial outlay, which is $306,170 minus $550,000 equals negative $243,830. Step 7, decision. Because net present value is negative, the project destroys value at a 12% discount. rate the firm should reject the machine.